LiteFinance,
Hello, it's Monday, November 13th, and it is a time to start the market forecast for this week, where today, apart from the calendar, which is heavily packed with a very important macro data, we will focus on the analysis of Euro USD. But first, the calendar. So on Monday, we will get OPEC monthly report, crude oil inventories. On Tuesday, we will get labor data from the UK, Eurozone GDP figures, US CPI inflation, and Japanese GDP. On Wednesday, China will publish their industrial production data, UK will publish their CPI, from the US we will receive a PPI, which is inflation on producers' side, and retail sales data. On Thursday, initial jobless claims from the US, and on Friday, a UK retail sales and Eurozone CPI final reading. So as you can see, the calendar is packed. Now we move to the broader analysis of the current macro situation on the Euro USD. So the lower the inflation growth rate falls, the more talk in the market that this is happening on its own. The main reason for the PCE index slowdown is a recovery in supply, not a decline in demand. However, if the Fed had not raised rates, the US dollar would have been weaker and the economy super hot. Monetary restriction affects demand, as a result of which loan rates increase. Their use by businesses and households decreases, and company costs increase. This leads to employee layoffs, rising unemployment, and a slowing consumer spending and GDP. None of the mentioned is happening in the US. Unemployment has remained below a half-century low for more than 2 years. Consumer spending jumped by 4% in the third quarter, while GDP expanded by 4.9%. However, the inflation rate is still falling. Once the supply chains disrupted by the pandemic are fully restored and fiscal stimulus is exhausted, inflation could fall below the 2% target because rates are currently 375 basis points higher than before COVID-19. Raising them even higher means deliberately driving the economy into deflation. The best solution is to keep the borrowing cost at the current level and change it depending on the released data. If it continues to fall rapidly, monetary policy will need to be loosened. However, not at such a fast pace as the derivatives market currently predicts. According to Nordea, the Fed will keep the federal funds rate at 5.5% in 2024, and the ECB will begin reducing borrowing costs in June. However, divergence in monetary policy will not lower the Euro-USD rate. The euro will be supported by improving global risk appetite and a slowing US economy. In 2023, American exceptionalism has greatly supported the greenback. However, the dollar is likely to lose this advantage soon. It's hard to imagine the US economy continuing to be as strong as it is now. Surely, GDP will slow down. Meanwhile, a soft landing in the Eurozone and China's progress will narrow the growth divergence and improve global risk appetite. As a result, according to Reuters experts, Euro-USD could rise to 107, 108, and 111 in 3, 6, and 12 months respectively. These are bullish forecasts that have so far failed to come true. Euro-USD will fall below 107 as investors were spooked over a potential Jerome Powell's hawkish statements. The Fed chairman did not talk about monetary policy in his first speech. If he does not mention this topic again, the euro rise above 107.25 will become a reason for adding up to long trades entered at 106.65. And that will be all from my side. Thank you guys for watching, and goodbye.